Hello, viewers. Our today's podcast is about market wizards. The purpose of this podcast is to awareness for the traders. So let's get started.
Welcome to the deep dive. Today, we're doing something a bit different. We're not focusing on, specific stocks or earnings reports.
No, instead, we're looking at maybe the best resource out there, the actual minds, the thinking of legendary traders, the market wizards.
Exactly. We've gone through their stories, their wins, but also their big failures to pull out those core ideas, the ones that really lead to long-term success in trading. Sometimes they're pretty counterintuitive.
Right. And the mission here is really about finding the shortcuts for you, getting to grips with what truly makes the market tick.
And when you look past all the noise, the charts, the algos, whatever asset they're trading.
Yeah, currency, stocks, futures, doesn't matter. You find there are really two things that are always constant.
Okay, what are they?
First, it's human psychology. It just doesn't change. Ego, fear, greed. They're always driving decisions.
Wow.
And second, you absolutely need strict risk management. Like brutally strict sometimes, those two things. Non-negotiable if you want to survive.
Okay, let's start with that first one then, psychology, because it jumps out from all these stories. Learning these lessons, it's expensive. The market makes you pay tuition.
Oh, it does. And failing early, that seems to be the norm, not really the exception.
That cost of being wrong, or maybe just the fear of being wrong, seems like the biggest hurdle.
It's definitely painful, but yeah, almost universal for traders starting out. Look at Michael Marcus, brilliant guy, early pioneer in systematic trading.
But he blew up first, right?
He hit rock bottom. Why? Because his ego convinced him he knew better. He shorted cotton based on what he thought was superior insight. Later admitted the data he used, some government stuff, was basically insufficient for any real market analysis. Total ego trap.
And these weren't just paper losses. I mean, he learned the hard way. Didn't he trade an account up to like $30,000, which was real money back then?
He did. And what did he do with it?
He bet the entire wad, didn't he? Plus money his mother lent him on some corn blight prediction.
Yep, all in on one trade. And the blight never happened. Lost everything.
Ouch. Yeah. Talk about a lesson in overtrading and position size.
Exactly. The market delivered it pretty brutally.
But what's interesting is how that kind of failure seems to forge the mindset you need later. Marty Schwartz is another great example.
Right. Schwartz was really open about this. He said he only turned the corner, only became consistently successful when something clicked.
What was it?
His desire to win became stronger than his desire to be right.
Okay, unpack that. Win versus be right.
Think about it. Why do most amateurs keep losing? They buy something, it goes down.
And they just hold on, hope it comes back. Maybe buy more even.
Exactly. They're waiting to get back to even so they can say they weren't wrong. Schwartz said most traders would literally rather lose money than admit they're wrong.
Wow. So they protect their ego instead of their capital?
Precisely. The master trader, they take the loss. Immediately, admit the mistake. Because that capital is their ammo for the next trade, the one that might actually work.
But that ego thing, it doesn't just vanish once you're successful, does it?
Not at all. It just shapeshifts. Paul Tudor Jones, this guy made insane returns, like 62% in the month of the '87 crash.
Legendary.
And yet he said something pretty striking. I am more scared now than I was at any point since I began trading.
More scared after all that success. Why?
Because he gets it. The market punishes complacency even harder than it punishes, say, ignorance. Both Jones and Schwartz mentioned this pattern. Their biggest losses, the really damaging ones, almost always came right after their biggest wins.
So you get euphoric, think you've cracked it.
And you get careless. You feel invincible. And that's exactly when the market just slams you. You have to keep that defensive mindset, that little bit of fear to survive long term.
Okay, so if ego is the killer, then defense is the antidote. That seems to be the thread connecting all these legends.
Absolutely. Defense, defense, defense. It's not about making money, not primarily. It's about protecting the capital you already have. That's the obsession.
Right, and risk control is like the cornerstone for Paul Tudor Jones.
Totally. He has these two critical defensive rules. First, never, ever average losers. Don't throw good money after bad just to lower your average cost.
Okay, rule one. What's two?
Rule two. Treat every single position you hold as if it's wrong right now, and you might need to get out immediately.
But Jones is managing huge amounts of money. Do those same rules apply if you're just trading your own smaller account? Is it practical?
Oh, absolutely. I'd argue they're more important for a smaller trader. because it's about protecting your psychology as much as your capital.
How so?
If you're always mentally prepared for a position to be wrong, you build in humility, you fight that ego, and he reinforces this with something he called the no cushion rule.
Ah, yeah, the no cushion rule. That one's brilliant. Explain that.
Okay, so every single morning, Jones would mentally reset his entry price to whatever the closing price was the night before.
Even if he was way up on the trade.
Especially then. Even with a huge open profit, he forced himself to look at it like he'd just put the trade on at the open.
So he never gets comfortable thinking, oh, I've got this big profit buffer.
Exactly. No cushion. It stops complacency dead. He's basically always got his foot hovering over the brake, never fully trusting the momentum, always ready to cut if things turn.
That's intense discipline. And it wasn't just individual trades, right? He had overall equity stops.
Yeah, hard stops on the entire fund's equity. Like if the fund drops, say, 6.5% in a month, boom. Trading stocks. Mandatory. No arguing, no trying to win it back, just stop.
Which brings us to Larry Hite. He took that defensive idea and almost made it mathematical.
Yeah, Hite had this revolutionary concept. We don't trade markets, we trade money.
Okay, that sounds a bit abstract. Trading money, not markets.
What he meant was, psychologically and mathematically, gold or cocoa or bonds. They were all the same to his system.
Ow.
He viewed every single trade, no matter the market, no matter how exciting it seemed, as just a 1% bet. That was the rule.
1%. Max risk per trade is 1% of your total capital.
1%.
That sounds slow. Painfully slow if you're trying to grow an account quickly.
It's painfully safe. That's the entire point. Lose one trade. You're down 1%. Lose 10 in a row. You're still only down about 9.5%.
Where you physically can't blow up your account with one bad call or one ego-driven mistake.
Exactly. It lets the trader just focus on executing the system, takes the emotion out of any single trade's outcome.
So he's like an insurance actuary, not a gambler. He can't predict the next card, but he knows the odds over thousands of hands.
That's a great analogy. He knows the outcome of 100,000 events mathematically because his system ensures he survives long enough for the positive expectancy to play out.
And his reason for this super disciplined approach comes back to
Psychology again. Hite would point to history, tulip bulbs in 1637, the 29 crash, silver in 1980. Markets change, sure, technology changes.
But people don't.
But people don't. Greed and fear are constant. And because they're constant, you can test systems rigorously over historical data, provided you stick to the rules.
This idea that trading isn't some innate gift, but a skill based on rules and discipline. That was kind of proven by Richard Dennis, right? With the turtle experiment.
Oh, the turtles, yeah. Classic story. Dennis basically made a bet with his partner. He argued he could take ordinary people, teach them a specific trading system with clear rules,
And turn them into successful traders.
and he did. He codified his knowledge, taught them money management, mechanical entry-exit rules, and many became hugely successful. It proved that mastery comes from learned discipline, not just raw talent.
Okay, so we've established mindset and risk are key. But the actual techniques, they have to adapt, right? Because the market itself changes.
Absolutely. Michael Marcus, who made his first fortune with trend-following systems, was very clear later on, the game he played back then, it's over.
What changed?
He talked about lagged follow-up basically disappearing. In the early days, he could buy a breakout.
And then sell it to the next wave of buyers who were a bit slower. The dentists, as they used to say.
Exactly. News traveled slower, reactions were delayed. There was time for that follow-through.
And now...
Now, that initial breakout isn't a trend starting. Often it's just a quick volatility spike. Computers, high-frequency traders, pro desks, they see it instantly.
So if you're trying to jump on board after the initial move,
You're often selling right into algorithmic selling pressure, not into new buyers. Marcus felt the markets became much more prone to false breakouts, to whipsaws.
the simple trend following got much harder.
He thought the easy days of just basic trend following were over, unless you had some massive, obvious macro force, like huge inflation or deflation driving things long term.
Okay, if trends are trickier, then picking the right stock becomes even more crucial. Let's talk William O'Neill and CanSlim.
Right, O'Neill's system is all about identifying specific markers of potential big winners, especially growth stocks.
A C and A are key, right? Earnings.
Yeah, C for current quarterly earnings, A for annual earnings growth. He looked for stocks with quarterly earnings per share up like at least 20-50% year over year. And strong multi-year growth, too. The EPS rank is vital, compares its earnings growth to all other stocks. You want the leaders.
And then there's Enu High Price.
Yeah.
This one messes with people's heads. He actually advised buying stocks making new highs.
He did. It flies in the face of what, like 98% of investors want to do. They see a new high and think, oh, it's too expensive now. I missed it.
But O'Neill said,
O'Neill found that the biggest winning stocks often started their massive runs by breaking out of long bases into new high ground. It signals strength, institutional buying. Waiting for it to pull back often means you're waiting for second-rate stock.
and he also took aim at a value investing staple, the low PE ratio, price to earnings.
Yeah, he really dismissed buying a stock just because it had a low PE, which many people see as meaning it's cheap. Because usually, it's low for a bad reason. There's an underlying problem with the company or its industry. O'Neill argued if you look back at the monster stocks, the biggest winners in history, almost none had low PEs when they started their runs.
They looked expensive.
They looked expensive because the market, correctly, saw huge future growth potential. Chasing low PEs, O'Neill thought, often just leads you to the dogs of the market.
Okay, so we've got systems, metrics, but not everyone trades like that. Jim Rogers is almost the complete opposite, right? Fundamental, patient.
Rogers is fascinating. He's like the anti-trader in some ways.
Right.
Relies on deep fundamental analysis and trades incredibly infrequently, maybe once every few years.
Waiting for what he calls money lying in the corner.
Exactly. He waits for situations where the value proposition is just screamingly obvious to him based on his global macro view, or conversely, where the market has gone completely nuts.
Buying value, selling hysteria.
That's his game. He sees the market as this big, complex puzzle, and he won't make a move until he feels he understands the whole picture.
His timing could be uncanny. Selling gold in 1980.
Yeah, sold at $675 an ounce, just 4 days off the absolute peak of that massive bubble. That willingness to stand against the herd when things get irrational is classic Rogers.
And he did the opposite in the 87 crash.
Right. While everyone else was panicking and dumping stocks, Rogers actually covered his shorts and went long during the crash week.
Why?
He saw it purely as a textbook case of hysteria. Not a fundamental breakdown, but a temporary panic creating extreme undervaluation. That's the kind of opportunity he'd wait years for.
Looking back across all these wizards, the common themes really are striking, aren't they?
They really are. It's not about being the smartest guy in the room or having some secret formula.
It's about discipline, unbending discipline.
And extreme risk control. Plus, maybe most importantly, humility. Realizing the market is always changing and can always prove you wrong.
Yeah, it seems being defensive like Jones or incredibly patient like Rogers wins out over being aggressive and letting your ego drive like maybe Schwartz was early on.
Definitely. And maybe the most challenging final thought on all this comes from Ed Seykota. He mentored a lot of top traders.
What did he say?
Someone asked him why so many people lose money trading. And Seykota's answer cuts deep. He said, everybody gets what they want out of the market.
Whoa, hang on. Everybody gets what they want. People don't want to lose money.
Don't they? Seykota's point is profound. If you're consistently losing, maybe, just maybe, on some subconscious level, you're fulfilling a different need.
Like what? A need to fail? Self-sabotage?
Wow.
Or just the excitement, the drama of it all?
Could be any of those. It forces you, the listener, to look beyond just your trading method or your rules. You have to ask, what are my deepest motivations for doing this?
What do you truly want from the market?
Because if Seykota and the other wizards are right, the market tends to give it to you. It reflects your inner state. If you truly want discipline and profit, you have to want that more than you want the thrill of the gamble or the ego boost of being right.
That is a powerful question to end on, something for everyone to think about. Thanks for tuning in to The Deep Dive.
So, I hope you guys understood and get some value from this podcast. Trading is not a rocket science. It's about just pure calculations and discipline. It doesn't matter how many times you trade. The only thing matter is, can you protect your portfolio or not? It's a game of psychology and mindset. Until next time, keep learning.